Picture this. You're at a classic Aussie backyard barbecue. The sun's out, the smell of grilled sausages fills the air, and you're surrounded by friends. In one hand, you've got the tongs, flipping steaks. In the other, a cold drink. It's the perfect setting for a bit of friendly banter. Dave, always the property guy, is bragging about his new house, convinced it's his golden ticket to early retirement. He's talking about capital growth, rental yields, and how you can't go wrong with bricks and mortar. Meanwhile, Sarah's on the other side of the table, raving about her tech stocks. She's just seen her portfolio jump 20% in a month and swears the share market is the only way to get rich these days. The debate heats up, and soon everyone's got an opinion.
So, what's the smarter way to build wealth, property or shares? Is it better to own a slice of suburbia or a piece of the world's biggest companies? It's a question that's sparked countless debates, not just at barbecues but around dinner tables, in group chats, and even in the break room at work.
This isn't just small talk. For most Aussies, it's one of the biggest financial decisions we'll ever make. Whether you're saving for your first home, thinking about investing for your kids' future, or planning for retirement, the choice between property and shares can shape your financial destiny. It's about more than just numbers. It's about your lifestyle, your goals, and your appetite for risk.
The media doesn't make it any easier. One week the headlines scream about a property boom, prices are soaring, and everyone's rushing to buy. The next, there's panic about a stock market crash, with experts warning of doom and gloom. It's no wonder so many people feel overwhelmed, confused, or even paralyzed by indecision. The noise can drown out the facts, making it hard to know what's really best for you.
The truth. Both property and shares have made everyday Aussies wealthy, but they work in totally different ways. Property offers the tangibility of bricks and land, the pride of home ownership, and the potential for rental income. Shares, on the other hand, give you access to global markets, instant diversification, and the magic of compounding returns. Each has its own set of risks, rewards, and rules of the game.
It's a bit like choosing between a ute and a sedan. Both will get you from A to B, but the ride, the comfort, and even the fuel costs are different. Some people love the security and stability of property, while others prefer the flexibility and growth potential of shares. There's no universal answer, just what fits your journey.
To make the right call, you need to understand the key differences: returns, risks, costs, and even the emotional side of ownership. Are you comfortable with debt? Do you want something you can touch and see, or are you happy to watch numbers grow on a screen? These are the questions that matter.
Let's break it all down, step by step. We'll look at how each investment works, what you need to get started, and the pros and cons that could tip the scales for you. By the end, you won't get a one-size-fits-all answer, but you will have the knowledge and confidence to weigh up your options and make a decision that suits your life, not just the latest headlines. So, whether you're team bricks, team clicks, or still on the fence, you're about to get a clear roadmap to figure out your best path forward. Let's dive in.
Australia's obsession with property is legendary. It's a passion that's woven into our national identity, shaping conversations at backyard barbecues and family gatherings. For many, the idea of owning a home isn't just about bricks and mortar. It's about security, status, and a sense of belonging. The dream of a place to call your own has driven generations to save, sacrifice, and strive for that elusive set of keys. For decades, owning a home has been the great Australian dream. It's a goal that's shaped our cities, influenced government policy, and even defined what success looks like for millions of Australians. But as times have changed, so too have the ways we build wealth and plan for the future.
In the 1990s, a quiet revolution began. Compulsory superannuation turned millions of everyday Australians into share investors, often without them even realizing it. Suddenly, people who'd never set foot on the stock market found themselves with a stake in the fortunes of Australia's biggest companies simply by going to work and getting paid.
So, while our hearts are with property, our retirement savings are quietly working away in shares. It's a split personality that's unique to Australia, where we dream of home ownership, but rely on the share market to fund our later years. The debate about which is better, property or shares, has never been more relevant. With house prices soaring and markets shifting, Australians are asking tough questions about where to put their hard-earned money.
So, how have these two giants of wealth creation actually performed? Let's look at the numbers and see what history tells us. Over the last 25 years, properties averaged about 6.8% annual growth. That's a solid return, especially when you consider the stability and tangible nature of real estate.
Shares, on the other hand, have delivered around 7% per year, before counting dividends. When you factor in those regular payouts, the total return from shares can be even higher. Add those dividends in, and shares often pull ahead of property in the long run. But the story doesn't end there.
But averages don't tell the whole story. Behind the numbers are real people, real risks, and real emotions. The path to building wealth is rarely smooth. The journey to those returns is wildly different. Property tends to move slowly, with long periods of steady growth, while shares can swing dramatically in a matter of days or even hours.
One's a steady climb, offering comfort and predictability. The other's a roller coaster, thrilling but sometimes nerve-wracking. Both can get you to your financial goals, but the ride feels very different. The destination might be similar, but how you get there, and how it feels along the way, matters more than ever in today's world. Let's talk about risk, the kind that makes your stomach churn and keeps you up at night. It's that uneasy feeling you get when you're not sure if your money is safe or if you might lose it all. Whether you're new to investing or have been at it for years, risk is always there, lurking in the background. It's a natural part of putting your money to work, and understanding it is the first step to making smarter decisions. Investing in shares is a bit like strapping yourself into a roller coaster. The ride can be thrilling, but it's not for the faint of heart. Share prices can soar one moment and plummet the next, sometimes within seconds. Every tick of the stock ticker brings a new wave of excitement or anxiety. The market reacts to news, rumors, and global events, making it unpredictable and sometimes overwhelming. Your savings can swing wildly in a single day. One morning, you might wake up to see your investments have grown, and by the afternoon, they could be down again. These sharp ups and downs can be nerve-wracking, especially if you're watching your portfolio closely. It's easy to panic when you see red numbers, but it's important to remember that volatility is normal in the share market.
Property, on the other hand, feels much safer to most people. You don't get daily price updates flashing in your face, so you're not constantly reminded of the value going up or down. The slow pace of property markets can be comforting, giving you a sense of stability and control. You can sit back, enjoy your home, and not worry about sudden changes. With property, you're almost forced to be a long-term investor. You can't just sell a room or a wall if you need cash. Instead, you're committed for years, riding out the ups and downs of the housing market. This long-term approach can help you avoid making rash decisions based on short-term price movements.
But don't be fooled. Property has its own set of risks. Things can go wrong, from unexpected repairs to changes in the local economy. A house might look like a safe bet, but it's not immune to problems. Foundations can crack, neighborhoods can decline, and costs can spiral out of control. Most people can only afford to buy one investment property, which means all your money is tied up in a single asset. If something goes wrong, you don't have other investments to fall back on. It's like putting all your eggs in one basket and hoping nothing happens to it.
If your suburb tanks, you can't just sell the bathroom. You're all in, whether the market is booming or busting. If property values drop in your area, you could be stuck with a loss that's hard to recover from. Unlike shares, you can't sell off a small piece to cut your losses.
Property is also what's called illiquid. That means it's hard to turn it into cash quickly. Selling a house can take weeks or even months, and there are lots of costs and paperwork involved. If you suddenly need money, you can't just snap your fingers and get it out of your property. You have to wait for a buyer, negotiate a price, and deal with agents and banks. It's a slow process, and sometimes you might have to sell for less than you hoped.
Shares are definitely more volatile, but they're also much more flexible. If you need cash, you can sell a small parcel of shares in minutes, often with just a few clicks. This liquidity gives you options and control over your money. Plus, with shares, it's easy to diversify. You can spread your money across different companies, industries, and even countries. This helps reduce your risk, because if one investment goes bad, others can help balance it out.
With a single index fund, you can own a slice of hundreds, even thousands of companies from all over the world. This means your money isn't tied to just one business or one industry. You're sharing in the growth of the entire market. If one company fails, it barely dents your portfolio. The losses from one are often offset by gains from others, making your investment journey smoother and less stressful in the long run. Here's the secret sauce for property leverage. Banks love lending for property, often up to 80% of its value.
That means you can control a 500k asset with just 100k's of your own money. If the property rises 10%, your return is 50% on your cash.
Plus, negative gearing lets you offset losses against your income for a tax refund.
But leverage cuts both ways. If the property drops 10%, you lose half your deposit.
Over-leverage can spell disaster if the market turns.
You can borrow to buy shares too, but margin loans are riskier. If shares fall, you might have to sell at the worst time.
Leverage can supercharge gains or losses. Use it wisely. Dreaming of riches? Don't forget the costs.
With property, you'll pay stamp duty, legal fees, inspections, loan fees, before you even get the keys.
Then come council rates, insurance, maintenance, and property management. Selling? Agents' fees and a big capital gains tax bill.
Shares are much cheaper. Buy or sell for a small brokerage fee. No stamp duty, no leaky taps.
Low-cost index funds charge tiny management fees. You keep more of your returns.
Shares also offer franked dividends, reducing your tax bill. You can sell gradually to manage capital gains.
Flexibility and low costs can make a huge difference to your final wealth. Need cash fast? With shares, just log in and sell. Money's in your account in days.
With property, selling is slow, expensive, and stressful. You can't just sell a room if you need 50k.
Diversification is another big difference. One property means one bet on one suburb.
Shares let you spread your risk across hundreds of companies and countries with a single fund.
If one part of your portfolio struggles, another might be booming. That's real risk management.
Investing isn't just about numbers. Property is tangible. You can see it, touch it, and control it.
That physical connection gives comfort and pride. It's a legacy you can pass down.
This emotional bond is why property is so deeply rooted in our culture.
Shares are intangible. You own a slice of a company, but it can feel abstract.
For some, that's a downside. For others, it's exciting. You're backing global innovation, not just bricks and mortar.
Shares let you be part of the world's progress, even if you can't drive past your investment. Don't just look in the rearview mirror. The future matters.
Australia's population is growing, driving housing demand. But affordability is a real issue.
Urbanization is changing what and where people want to buy. Policy changes could shake things up.
Shares are shaped by global trends, technology, sustainability, and demographics.
More investors want their money to do good, not just make money.
Superannuation keeps a river of money flowing into shares, supporting prices.
Shares give you a ticket to global trends that property can't match. So, what's the verdict? There's no single right answer.
Do you crave control and a physical asset? Or do you want flexibility and global reach?
If you love projects and don't mind debt, property could be for you. Just know the costs and commitment.
Prefer simplicity and liquidity? Shares are hard to beat. Diversify globally in minutes.
You don't have to pick just one. Many people combine both, owning a home and building a share portfolio.
Understand the strengths and weaknesses. Build a plan that fits you. It's your money, your future. Make your call.